Okay, so the Ichimoku cloud is a effective dynamic trend-following technical indicator developed on for about 30 years before being introduced to the public in 1969. So they've been working on this one for a while. The Japanese name for the indicator is the Ichimoku Kinko Hyo, which roughly translates to English as the at-a-glance equilibrium chart, but we just call it the Ichimoku cloud in the West. The man behind the indicator is a Japanese journalist named Guichi Hoshida, who tracked the rice futures market back then. He came up with the Ichimoku cloud indicator um, as a way to help him identify support and resistance in the rice futures market at the time. If it's your first time looking at the Ichimoku cloud indicator, it may look like an incomprehensible mess of different lines on your chart, but it's really not as confusing as you may seem. Oh, as it may seem. It's a simple yet intricate and effective tool for analyzing and identifying the trend of a stock. So indicator is made up of 5 different lines on the chart. So we've got the Tenkan-sen conversion line, blue line right here, and then we've got the Kijun-sen baseline, this purple line right here, and then we've got the Senku span A, we're just going to call this the span A. The span A line over here that makes up the top section of the cloud, and then the span B line, Senku span B line, that makes up the bottom section of the cloud. Now we've got the cloud itself, but this is just a formation of these two lines. And then the last line we've got is the Chiku span lagging line. So we'll go over the Tenkan-sen conversion line and the Kijun-sen baseline first. The Tenkan-sen conversion line is a moving average line that's created by adding the highest and lowest points of a stock, or the highest and lowest prices of a stock over the last 9 candle periods. So you'd be taking the last 9 candles and adding them together, then dividing by 2 to average out and create this blue line. The Tenkan-sen conversion line is used to gauge the immediate to short-term support and resistance on the chart, because the formulation with only 9 periods of data points makes it more short-term usage. It doesn't have as much historical data to use to chart out support and resistance. That's why it's a little bit more short-term. If the price of the stock is above the Tenkan-sen conversion line, then the Tenkan-sen conversion line will act as support, and vice versa, the price of the stock is below the line. So in this case, you see right now, the price of the stock is below the Tenkan-sen conversion line. That means this line is currently acting as resistance. The Kijun-sen baseline is a moving average that's created by adding the highest and lowest prices of the stock over a 26 candle period, so using the last 26 candles. And then adding that together, then dividing by 2. This line is used to help you identify the midpoint of a stock, as well as to gauge the short-term to mid-term support and resistance. If the share price is above the Kijun line, then that indicates the price of the stock is above the midpoint. If the stock is above the Kijun-sen baseline and the Kijun-sen baseline is angled upwards, this further indicates that the short-term momentum of the stock is bullish. So if you get like a really steep line, like for example right there, the Kijun-sen baseline, that means that the stock actually has a lot of bullish momentum during this time frame that it's over. Now, this operates in the same way for support and resistance as the Tenkan-sen conversion line. If the share price is above the Kijun-sen baseline, then this baseline will act as support. If the share price is below it, then it'll act as resistance. In this case, share price candle closed below it, so this line is acting as resistance for the stock right now. So the Kijun-sen baseline is considered one of the most important lines in the Ichimoku cloud indicator because of its longer time frame data point usage, which makes it more reliable when it comes to finding more accurate and significant support and resistance levels in the chart. So both the Tenkan-sen conversion line and the Kijun-sen baseline work in conjunction with each other to help create buy and sell signals. When the Tenkan-sen conversion line crosses above the Kijun-sen baseline, so crossover is not on this chart, but I'll show you an example later, then traders typically identify that as a buy signal. So when the Tenkan-sen conversion line crosses below the Kijun-sen baseline, so if this blue line crosses below this purple line, then traders typically identify that as a sell signal. This crossover is referred to as a TK crossover, so Tenkan-sen, Kijun-sen, TK crossover. We'll delve more into that later, though. So next up, we've got the Senku span A and Senku span B line. Both of these lines make up the cloud part of the chart itself. So The cloud is an indicator that has the green and red color fill-in. So you got the red right there, you got the green right here. The span A line is the top line of the cloud when the cloud is green. The span B line is the bottom line of the cloud when the cloud is green. So when the cloud is red, the span B line is going to be on the bottom, and the span A, I'm sorry, when the cloud is red, the span A line is going to be at the bottom of the cloud, and the span B line is going to be on the top of the cloud. The psychospan A line, the span A line right here, it's a moving average created by combining both the Tekkenson conversion line and the Kujanson baseline. So you basically take the calculations of the Tekkenson conversion line and the Kujanson baseline, add them together, and then divide by 2 to create this span A line. So after you do that, then you plot this line 26 periods into the future. So you can see how the cloud is actually ahead of the share price at the current time frame. So you plotted 26 candle points forward. So if you're looking at a 5-minute chart, it's going to be 26 candles into the future. If you look at the daily chart, it's going to be 26 candles into the future as well. It's the same concept. So the span B line is a moving average created by adding the highest and lowest prices 52 candle periods, and then dividing by 2, and then plotting the line 26 periods into the future as well. So this span B line is basically a 52-day moving average, except it's not like the Western type of moving average where you take the closing price of the last 52 candles, add them together, and then divide them by 2. So instead of, dividing by 9, I'm sorry. So instead, you actually add the highest and lowest points of the last 52 candles instead, and then divide them by 2 instead. So the Japanese method of creating these moving averages is to chart out the midpoint of the stock instead of charting out, a simple moving average alone. There's fundamental differences there. So the thickness of the cloud, well, let's go over what exactly the cloud is for reference first. So basically, the cloud is green, then the overall trend of the stock is assumed to be bullish. If the cloud is red, then the overall trend of the stock is assumed to be bearish. If the share price is above the cloud, then it's considered a bullish trend. If the share price is below the cloud, it's considered a bearish trend. If the share price is playing within the cloud, then that means that the stock is currently in the consolidation phase. So if the stock is in the consolidation phase, that means that the stock doesn't have a definite trend up or a definite trend down right now. It's kind of 50-50. There's a chance that it'll break out above, there's a chance it'll break down below. So the thickness of the cloud is an important indicator of how likely the price is to break either above or below the cloud. The thicker the cloud, the harder it'll be for the price to break through the cloud completely. So the thinner the cloud, the easier it is for the price to break through the cloud. In a thick cloud, the stock will have an easier time breaking through one line of the cloud, but it'll have a harder time breaking completely through the cloud altogether because the support and resistance of the cloud is spread out throughout the thickness of the cloud. So thin clouds tend to have the most significant support and resistance levels focused on the span A and span B lines themselves. So the span A lines, the span B lines in a thin cloud is going to be where most of the support and resistance is focused on. If the share price manages to break through one of the lines in a thin cloud, then it's going to have a greater chance of breaking through the second line as well. So typically, if you're watching a stock that's going up, it's really bullish, you're going to want to see a big cloud down below, because if it hits a big cloud, it'll bounce off of support, or it'll break into the cloud and have a lot of support spread out throughout this whole range to give you a good chance of the stock going back up. So a common question about the span A and span B lines is if it signifies anything when the span A line crosses above the span B line. When the span A line and when the span A line and the span B line cross over each other, it doesn't really signify anything. So when it crosses over, the span A line's on the bottom, span B line's on the top, and the cloud is just red. So it's really all it does. The additional 26 periods predictive nature of the cloud over here is there to help you determine where it thinks the support and resistance will be for the stock 26 periods into the future. So for example, right here, you can see that it actually played out. The stock came down, it bounced on the top line support of the cloud, went back up. And the cloud portion of the indicator that's charted 26 periods forward, that's basically what it does. It's the prediction of where it thinks the trend will potentially go. So it predicts that it's still going to be bullish, it's green, and that the support and resistance will progressively move up. So the distance between the share price and where the cloud is doesn't signify anything either. So how far away this stock is, either above it or below it, it doesn't really signify anything in particular. All it does is it shows you where the support and resistance of the cloud is and how big of a range there is between where the share price is with the support of the cloud or the share price is within the resistance of the cloud. So if the share price is pretty far below the cloud and there's a nice bull run signal, then there's a good chance that you can have a pretty decent play because there's actually a nice price range. If the stock is right here, TK crossover to the upside, there's actually good momentum on correlation confirmation indicators and the other indicators in the Ichimoku cloud, then you could buy here and then ride it up here before you actually meet any significant resistance. So the last line of the indicator is the HaiKhuu span lagging line. This is a red line over here. So this line is created by taking the closing price of the stock every day and charting it back 26 candle periods. So basically what it does is it takes all of these closing prices, copies them, and then moves them back 26 days. So this may sound relatively useless, but its main purpose is to help you gauge the direction and intensity of the stock by looking at where price is now compared to where it was the last 26 candles back. If the HaiKhuu lagging line is above the share price 26 days ago, then that signifies that the stock is currently likely to be in a bull trend. So in this case, this lagging line is below the share price of the 26 day back on the chart. So it's indicating that momentum is slowing down and there's a chance that the stock will start beginning a downtrend. If the HaiKhuu lagging line is below the stock price 26 days ago, then that signifies that the stock is currently likely to be in a bearish trend, which is what we're seeing right now. The HaiKhuu span is currently below the price, so it's starting to signify that the stock is starting to head into a bearish trend. So as you can see, the SPY share price is actually below both the TK Tekkensen and the Kujinsen line, and it's signifying that there's a downtrend beginning to happen. However, the overall trend of the stock right now is still technically bullish because it's above the cloud. When the share price breaks into the cloud, then it's considered to be in the consolidation phase. If it breaks below the cloud, then it's considered to be overall trend is bearish. If the HaiKhuu span lagging line, this lagging line back here, is above the cloud, when this is above the cloud like in general, then it indicates the overall trend is likely to be bullish. If the HaiKhuu span lagging line is below the cloud, then it indicates the overall trend is likely to be bearish. So if this line above the cloud, bullish. This line below the cloud, likely to be bearish. So now that we've gone over all 5 lines of the Ichimoku cloud indicator, we'll go over how it's utilized to help you identify the trend of a stock and when to buy and sell. So let's go ahead and pull up a stock real quick. Let's say Micron. Let's look at a 1-day, 5-minute time frame. So the main signal used for determining when to buy and sell a stock is when a TK crossover occurs. So TK crossover right there is an example of TK crossover. Another TK crossover right here as well. So the TK crossover is a signal that occurs when the Tenkan-sen conversion line crosses above or below the Kujin-sen baseline. So if this blue line here, which is the conversion line, crosses above the Kujin-sen baseline, then that signifies that there's a TK crossover to the upside. And vice versa, if this line crosses below the Kujin-sen line, that means it's a crossover, TK crossover to the downside. So this generally means that there's a sell signal going on, and this generally means that there's a buy signal. And assuming that there isn't a fake out, and I'll get into what a fake out looks like in a little bit. So when a TK crossover to the upside happens, you want the share price here to already be above the Tenkan-sen conversion line, and you want the Kujin-sen baseline to be angled up about 30 degrees to 45 degrees for the most optimal buy signal. And that's the same case for TK crossover to the downside. So for TK crossover to the downside, you want the share price to already be below the Tekkensen conversion line, and you want the Kijun baseline to be angled about 30 to 40, 45 degrees for the most optimal sell signal. So this purple line is best if it's angled drastically. Well, not too drastically, but it's angled like 30 degrees or 45 degrees in whatever direction you're looking at for the TK crossover, either to the upside or the downside. So the Ichimoku cloud indicator set it works best in trending markets. So in the case of TK crossovers, you'd want the Kijun baseline to be angled as much as possible for good signals instead of being flat or moving up and down at a very low angle. If the Kijun baseline and the Tekkensen conversion line is flat, then this typically indicates that the stock is not trending up or down significantly, and typically this is seen on stagnant stocks or when the stock is entering a consolidation phase. If a TK crossover to the upside happens, but the share price is below the Tekkensen conversion line as it happens, then the signal will most likely not play out and be considered a fake out. So, for example, over here, on this point where the TK crossover happens, this is a buy signal. But if the share price is below the blue line when this crossover happens, then it's very likely that this signal is a fake out and it's a signal that you shouldn't take. So it's the same case for a TK crossover to the downside. If you got a TK crossover to the downside here, but the stock is already above the conversion line when the crossover happens, then it's likely it's going to be a fake out and it's not going to play out. So it's a percentage chance type of deal with fake outs. Sometimes the fake out will still play out, but most often the fake out won't actually play out. So the traditional guidelines of when you should take a TK crossover buy or sell signal is based on where the TK crossover happens on the chart. So if a TK crossover to the upside happens above the cloud, it's considered a strong buy signal. If the TK crossover to the upside happens below the cloud, it's considered to be a weak buy signal. If a TK crossover to the upside happens inside the cloud, it's a neutral buy signal. If a TK crossover to the downside happens below the cloud, it's considered to be a strong sell signal. So TK crossover to the downside, if this was down here instead below the cloud, is considered a strong signal. If the TK crossover to the downside happens above the cloud, it's considered to be a weak sell signal. So in this case, this is a weak sell signal, but it did play out. Now, if the TK crossover to the downside happens inside the cloud, it's also considered to be a neutral sell signal. So if this happens, or if this happens inside the cloud, it'll either be a neutral sell signal or a neutral buy signal. When you're basing your trade entries and exits off of the TK crossover signals, you want to watch the Tekkensen conversion line as short-term support for the stock. Stocks move upwards or downwards. The Kijun baseline will be your secondary line of support if the stock breaks below the Tekkensen conversion line. Note, in order for this to be a significant break of support, the candle has to close below the support line. So let's go over crossovers real quick. You've got Micron. The stock opened up. This is the TK crossover to the downside, right? But it's above the cloud. It's a weak sell signal. You wouldn't really take it, but it already played out. So it's already down here. The stock actually bounced on the top line support of the cloud, went back up. It broke through the conversion line resistance, and it also shot straight through the Kijun baseline, which was also acting as resistance. TK crossover here. So since it's a TK crossover to the upside that happened above the cloud, it's a strong buy signal. So in this case, you'd probably grab some shares right here, and then you'd use this blue conversion line as your support. You can use this purple Kijun baseline as your support as well, but it's pretty low. In this case, I'd rather ride this blue line up and then take profits as it breaks below this conversion support line up here. That makes sense. So you could use this Kijun baseline as support as well, but in this case, you would have taken a bit less profit, even though you would still have been taking profit once it broke below it. After it broke below it, it managed to hold and to break back above shortly after. But there was a TK crossover to the downside here. But if the share price is above the conversion line, so this is typically a pretty bad signal. It's not a signal you would take for a sell signal. It happened above the cloud. Traditionally, you wouldn't take a sell signal that happens above the cloud anyway. So on top of that, the Kujin line, the baseline here is actually pretty flat. There's not a very significant angle. So you want it to angle, you want it to have like a 30-degree angle or a 45-degree angle instead. You don't see that, so that's another reason why this is a bad sell signal. So technically that would have been a fake out, but it did end up playing out over time for a little bit. So it did drop down below the supports, and it did start using the conversion line as resistance, and it did use the Kujin line as resistance for a little bit as well, about 3 candles after its breakthrough support. And towards the end of the day, it did start retracing back up. So you got a TK crossover inside the cloud right here. Could take it if you want, but it doesn't have much of an angle with the baseline, like 30-degree, 45-degree angle. So it's not exactly a very strong buy signal. And the buy signal happened inside the cloud as well. So it's technically a neutral buy signal. Yeah, it's kind of a toss of a coin if you want to take this type of buy signal. So assuming you bought in on the crossover, that should be this candle. You wouldn't really have made any money because you would have gotten stopped out right here and it broke below the conversion line. So it's an indication that this wasn't a very good play. And you probably wouldn't have wanted to get into this play anyway because there wasn't a very steep angle with this Kujinsen line right here. And after that, there really wasn't much, really wasn't any clear buy signals after that for Micron towards the end of the day. So I could probably pull up a couple of more charts. So Western Digital market opened up. It went up, suddenly tanked. I'm assuming this tanking catalyst was general market reaction. Market was going down after open not too long. After open on Friday. So it tanked down, broke through supports, started retracing back up. TK crossover to the downside, but it's not exactly a crossover to the downside here because this is more of a fake out because as it was crossing over, this candle literally blew through the resistance lines. So in this case, you could potentially make a buy order when it broke above this baseline, this Kujinsen baseline, this purple line, if you wanted to, but it's not an optimal trade. It's kind of a risky trade. You could get stop out in many cases with this type of move. So there's actually a clear buy signal right here, but the problem is the buy signal is already, share price is already kind of high after the buy signal has been confirmed. So that's the confirmation nature of the Ichimoku cloud. I'll get into that in a little bit. So there's a buy signal here. You could buy here if you wanted to. If you buy here, you probably buy at the best around $69 on this candle. At worst, you'd buy towards the top at $69.43. So if you bought into this candle, then you'd hold it. You'd use this conversion line of support, and you would ride this all the way up till this candle where you sell out, because this candle actually closed below the conversion line support. This candle right here, even though it did break below it, it didn't close below the conversion line. So remember what I said earlier about significant breaks below support. The break below support is only significant and confirmed if the candle closes below the support line. If the candle has a wick below the support line, or if the candle started below the support line but closed above it, then it completely negates the fact that the candle was actually below that support line at some point during that 5-minute, 1-minute time frame that the candle's been charted out as. Does that make sense? So you'd essentially be buying here, and then you would be selling up here. So that's whatever percentage move that is. Assuming this isn't a stock that's only got a 1% move, because you wouldn't have made a whole lot. But if there was a stock that had this sort of pattern, but there was a higher percentage move for that chart on that particular day, then you'd have a higher chance of making more profit or more percentage gains. So after it broke below the conversion line, you can see that it kind of used the conversion line of resistance for a while, dropped down, it tried to break out above. It did actually break out above. So you could buy it there as a potential entry point, but it's not a TK crossover to the upside. So there's a there's a chance that it's not going to play out at all. There's not enough momentum. And as you can see, there wasn't enough momentum to actually carry the share price above the conversion line and continue moving up. It kind of turned around after this candle broke above. See it, the next candle opened above, but it completely broke down through support. And you can see how this next candle was using the Kujan baseline as support for a little bit, and then the candle after that opened below the line, but closed above the Kujan support line and the conversion line. TK crossover to the downside over here, weak sell signal above the cloud. So in most cases, this would be a fake out, but in this particular case, it actually played out for the crossover to the downside, except it took a little bit of time for it to play out. So when the TK crossover to the downside happened over here, above the cloud, weak sell signal, but the share price was already above the conversion line, and it stayed above the conversion line, even stayed above the baseline for a while before finally losing its bull momentum and completely breaking down below. However, if like you wouldn't take this as a sell signal in most cases. So it broke below support. It actually used the conversion line support for a little bit, 3 candles over here, but it completely failed to hold above it on the 4th candle and broke below. Started dropping. You can see the wicks that are close to the conversion line resistance here. Kind of use that resistance line. And then when I got to the top line of the cloud, it attempted to use top line of the cloud as support, but it didn't. It wasn't able to hold onto that support line either, so it started breaking into the cloud. See how the resistance line is also progressively moving further down as the cloud support is moving up. So in this case, if the share price is playing between these two lines more, so like the candle, the base of the candle is actually longer and between these two lines, then there's a potential that there's going to be a squeeze either to the upside or the downside that's pretty exaggerated, more extreme. But in this case, the last 2 candles that were edging into the cloud weren't very prominent. It didn't have a very strong move. So there was no candle that was stretching from the bottom of the cloud. I'm sorry, from the top line of the cloud to the conversion line that's acting as resistance going down. Broke down below, was inside the cloud for a while, tested resistance here for a little bit before edging through it and breaking back above. But for the rest of the day, it kind of moved sideways. No clear buy signal since everything's flattened out. The Kujan line's kind of flattened out. The conversion line doesn't have as much angling either. There's no buy signal. That was the end of all trading for Western Digital for that day. No clear signals after that. So by looking at the location of the price of the stock in relation to the lines provided by the Ichimoku cloud indicator, you should be able to determine what the trend of a stock is at a glance of the chart. So this chart, share price below cloud, overall trend bearish. Let's see another stock, Tesla, for example. Overall trend of the stock is bearish as well, closed below the cloud. We can look at Coca-Cola, KO. They opened, TK crushed with the downside, failed to break above resistance for a while, finally broke above a little bit. You could play this range from here to here if you wanted to, but it's not a buy signal. Typically, you wouldn't. TK crossover to the upside, weak buy signal, happened below the cloud. The conversion line over here was most likely below the share price when this crossover to the upside happened. Probably back over here or over here. It's about 26 periods back. So it wouldn't be a buy signal you would take either because of where the location of the lagging line ended, where it was ending at the time this crossover happened. So it rode on support for a little bit, broke below it, started edging sideways, using conversion line resistance again, and it just continued on its downtrend throughout the rest of the day. There were no other buy signals that told you to buy any position into this stock after this buy signal, but it wasn't a good buy signal, so you wouldn't have taken it anyway. You got a TK crossover to the downside over here, Share prices are already below the conversion line when it happened. It played out, used the conversion line as resistance, kept on trailing down before breaking back above. No signal indicating cross to the upside. No indication that there's any good buy signals. Kept on going into close. So you would be using the span A, span B lines, Tekkinson and Kujinson lines as your support and resistance for the chart, basically. Now that's essentially how you use the indicator. There are more nuances to it. Um, in order to best utilize this technical indicator, you need to understand the strength and weaknesses of the indicator. So the Ichimoku cloud is effective for usage over various charting time frames, but the indicator was initially designed for daily time frame usage only, but it's been shown to be versatile enough to work with various time frames from 1 day, 1 minute to 1 day, 5 minute, hourly, all the way to weekly charts. So you can experiment with it and figure out what time frames you want to trade, and you chart for the time frame you want to trade in. So if you want to trade multiple days, maybe hold the stock for a week or so, then you'd be looking at the daily time frame. If you want to trade the stock intraday, you want to make a day trade, either it's a scalp or a slow moving day trade, then you'd be looking at the 5 minute time frame if it's like a slow moving intraday day trade, or if it's a scalp, if you look at the 1 minute day trade. I'm sorry, the 1 minute time frame. So, for example, if I was looking at the 1 minute time frame for Coca-Cola, it's going to give you more buy signals, more sell signals, because the um, the data points are closer together. It's a shorter time frame. You could use this for day trading. Well, obviously KO is not a very good stock to day trade on Friday, last Friday. But if you were using this 1 minute time frame to chart out when you should be making entries and making exits, and you wanted to see where the more significant support and resistance levels are for Coca-Cola when you're looking at the chart, then you can switch over to the 5 minute time frame and see where the more significant resistance levels or more significant support levels are based off of the 5 minute time frame. So if you're looking at Coca-Cola and let's say Coca-Cola broke above the cloud here, there was a weak buy signal here. It didn't actually play out, but after it got into the cloud, then it started playing out. It started going up, and then it sold right here, and it's coming back down. So if you're wondering if, since it already broke up above the Tekkinson conversion line here and was using a support, and you wanted to see where the resistance was this particular move, then you could go back. Let's see what time it is. This is 11:19 about where it ended. So we can go to the one day 5 minute, and we'd look at 11:15, 11:20. So then we'd be able to see where the resistance for that particular move would be. So 11:19 about here. That's where it ended on the 1 minute. It began back here on the 1 minute chart. So you see on its run up, this is a significant resistance level on a 5 minute, and the significant resistance before it actually started making a good bull run for the rest of the day, it would have to break through this cloud. So this resistance line up here was about 50.01, and I got nowhere near it on the 5 minute time frame. So the likelihood of this stock on the 1 minute continuing its uptrend for a very long period of time is very unlikely because it broke below pretty quick. It's got a long way to go before it can even get to the resistance of the cloud. And if it gets to the resistance cloud, there's no indication, there's no guarantee that it'll actually break through the cloud completely and start a bull trend for the day. So the Ichimoku cloud indicator, it's designed to show you confirmations of a trend shift and what the current trend direction is, opposed to predictive indicators that aim to help you get into a move up or down before it happens. So the Ichimoku cloud is more designed to help you more designed to help you get into the stock when a buy signal happens, when it's, well, let's say a buy signal for the Ichimoku cloud indicator only comes up, good buy signals that is, only comes up when it's confirmed that the trend has shifted either to the upside or the downside. So due to the nature of the indicator, it'll give you more signals. Due to this nature of the indicator, it'll give you more signals to get in or out of a trade based on confirmed trend shifts, therefore increasing your success rate instead of throwing a bunch of predictive entries and exit signals with more varied success with predictive indicators instead of confirmation indicators. The Ichimoku cloud indicator is best used with trending markets. So stocks that have low volume or low volatility or only move sideways over long periods of time are not ideal for charting with the Ichimoku cloud. So it's stocks that aren't moving will give you useless signals or entries and exits. The lines will be flat. There's going to be no clear, no strong buy signals, no weak sell signals. I mean, no strong sell signals. So you're going to want to use the Ichimoku cloud indicator with stocks that actually have a price range movement. So stocks that actually have volatility, actually have volume. If you're looking at a pharmaceutical stock that doesn't really have any volume, let's see if I can think of one off the top of my head that's pretty dead. This is a good example. So it was a trending stock at the beginning of the day, TK crossed over the downside, but throughout the rest of the day, there wasn't much volatility. You see, it didn't even move 1% that whole day, and its move up and down was very, very janky. There wasn't a very, very clear move up, very, very, very clear move down. Pfizer, though, on a daily time frame, isn't considered a stagnant stock. There's actually trending action on a longer time frame. There are other pharmaceutical stocks that are actually pretty flatline even on a daily time frame. I'm trying to think of some hype stocks. Let's see. This is a good one. No, this one has some range too.
What about Ford?
Tops. This stock does not have a lot of trending information. So from here all the way to about here, there was little to no trending happening for tops. As you can see, it's pretty
was
dead.
trading
So
like under the cloud for a long ass time.
Yeah, so like this stock would not be optimal for using the Ichimoku cloud as an indicator because it doesn't have any trending action, price action. So you want to use this indicator for stocks that actually have trending action. Now, one of the weaknesses the Ichimoku cloud indicator has is that it requires historical data in order to chart out its support and resistance lines to give you buy and sell signal. So like Palantir, for example, wouldn't like when it's IPO'd, you'd have to wait this long, up to 52 candles afterwards, before you actually start getting data points that you can use to determine where support and resistance is. What are the cons of this indicator? So if you're looking at IPOs, looking at day trade IPOs, you have to wait for 52 minutes before you start getting any sort of data points plotted onto the chart. Without historical data, the indicator will be unable to plot out lines on the chart. So IPO stocks kind of no-go with Ichimoku Cloud.
Try and go
You're going to
to
want to use leading indicators. So they will require longer time periods so you can actually get charting data. Now, it's finally got some charting data here, but from like this whole time frame back here since it IPO'd, you don't have anything. You don't have anything to really go off of if you're using this indicator.
check out 5 and below. FIV.
FIV. What about this one? It's a trending stock. It's got data points. Did you have a specific question about this, or did you want me to go over it?
I just wanted to see the shit, the trending shit that you were talking about.
So yeah, it's a trending stock. It's got data points to go off of. As you can see, it's got that janky volatility is probably due to some sort of news catalyst. You've got TK crossover to the upside over here. It's pretty steep, even though the lines are kind of close. So there's indication that it could be a strong crossover. Typically, you wouldn't get it because it's crossover below the cloud. But looking at the Chiku span line, I think it actually ended back here when this crossover was happening. So you could buy it and use this conversion line support. And if you did, you'd be in the money pretty well. You'd buy it here, this red candle, and you ride it up. On this break over here, you'd bail out and you'd sell. And then when it broke back above over here, you would buy again, sell again. You could probably make a little bit of money there, not a whole lot. Worst case scenario, you'd lose a tiny little bit. It's not a clear buy signal either, so this is just a momentum predictive play. If you were to buy when it broke back above the conversion line, you'd sell, and you would potentially buy again here if you were more risk adverse. Hold, wait, use this dynamic, use the conversion line over here as a dynamic stop loss, and then bail out when it broke below it over here. Buy it again when it broke above over here if you want to. Up to you. And sell over here, make profit. Not a whole lot, but profit's profit. Now that's FIV. Now, the Ichimoku cloud is a lagging indicator. So lagging indicators confirm price movements and trend shifts after they have already occurred, opposed to leading indicators like the CCI, Commodity Channel Index, or the RSI, Relative Strength Index, that tend to try to predict trend shifts before they occur. This can be both a strength or a weakness depending on what type of trading style you prefer to have. So when a TK crossover happens to the upside, typically that's just a confirmation that the stock is in like a bull trend. And as you can see, the stock started the bull trend from down here and going up before, and then the TK crossover happened over here, confirming that it's now in a bull trend. So it's kind of like a late indicator, but because it bases its buy and sell signals off of confirmed trend shifts, there's less predictive guessing with this sort of indicator. So you're more likely to get into trades that are confirmed to be moving up than to get into trades and using your technical indicator predicting that it'll go up and then it not actually going back up or making its bull run up. So since the another one of the weaknesses it has is that the Ichimoku cloud, it's an indicator set. So there's already 5 lines that make up the indicator on your chart. If you're using multiple indicators along with Ichimoku cloud, and the indicators are plotted out onto this chart up here, then it can make reading the chart more difficult. And if you have too many indicators in the chart, it makes it incredibly hard to read. So that kind of leads to information paralysis. And information paralysis will, more often than not, lower the efficiency of your trading overall. So that's basically how the Ichimoku cloud is used, how you can utilize it. Anybody have any questions, any charts you want me to look at? I can go over those.
Hey Fred, just wanted to say thanks for giving us this class and hope you're feeling better. Since we're on this chart, what I had a question about was, like, we have all of these different types of indicators, so which ones take precedence over another? So for example, if you have a TK cross to the upside, but you don't see enough volume or your RSI is indicating it might be oversold, how do you kind of prioritize those? And since like this kind of is a trend indicator, do you really rely on the MACD as much or not?
So that's a good question. I use the Ichimoku cloud indicator as my main indicator set that I rely on. I rely on this indicator more than I do with the RSI and MACD. The relative strength index and the moving average convergence divergence indicator down here I use as correlation confirmation indicators with my Ichimoku cloud. So I use these 2 indicators to confirm what I'm seeing with the Ichimoku cloud and make my buy or sell decision based off of if both of these indicators down below are also giving me the same signal to buy. So I put most weight on this Ichimoku Cloud indicator, but these two indicators help me further confirm if I should actually get in or if I should bail out. Does that make sense?
Okay, thanks. That makes sense. So, say for example, you decided to hop in at what is it, whatever the middle is, with the TK cross to the upside, and then for example, you see that on the MACD or the RSI, the trend suddenly shifted. Would you get out of your trade prematurely, or would you just wait and set your stop loss to the what is it, the TK line?
The conversion line, the blue line. You
Yeah.
can use this the Tekken line. I'm sorry. You can use this Kujin, this purple line, baseline if you want as stop loss, but in most cases, it's more secure to take your profits when the stock breaks below the conversion line. You'll more likely secure higher profits. So in the case that I see a trend shift to the downside on a play that's going up with the RSI or the MACD, I'll still put more weight on the Ichimoku Cloud indicator. I'll still use this dynamic support line, this conversion line, as my stop loss instead of um, selling when I see a reversal on either of these indicators. So like, for example, here on the RSI, it shows that this section of the chart is oversold. And it very likely could be oversold. But just because it gets into the oversold range up here doesn't mean I'll be bailing out. I'm still going to be using this conversion line as support, support up until it breaks below the conversion line up here, where I'd bail out and take profits. Now, the
Okay.
MACD in this case is a very clear indication that the bull trend is still continuing. It did show that it started slowing down here, but the share price picked back up over here. There's like more buyer momentum. I don't know if you guys know how to use the MACD indicator. I can go over that a little bit later as well. It's a pretty handy tool for showing you what the momentum of the stock currently is, of the overall strength is bullish or bearish. A lot of people end up using the MACD as a buy sell indicator, and it's not what it's designed to do. So the Ichimoku Cloud, it's a simple to use once you understand how to use an indicator, but hard to master. It's kind of like the RSI. There's a lot of nuances that are in the RSI after you use it for a longer period of time to like learn what exactly you should do when it's telling you it's overbought or oversold. So it's easy to use, but there are a lot of things you'll pick up over time. The longer you use it, the more experience you have with this indicator, the better you will be at determining when you should take buy signals, when you should take sell signals. If you guys don't have any more questions or charts for me to look at, I can start going over the MACD indicator real quick.
Maybe just for everyone. You mentioned on the Ichimoku charts that Tenkan-sen line is where you set your dynamic stop loss. So how do you adjust that as you go about the trading day? Like, is it something you manually input? Is it a
You have to
hotkey?
manually input that, or you can keep it as a mental stop loss. And if it breaks below, go ahead and set an order to get out.
Okay, so once
You could potentially design a custom Thinkorswim script to have a stop loss that dynamically follows this support line, but that would require more knowledge with ThinkScript, which is the coding language that Thinkorswim uses. So you can definitely do it because, well, you can probably do it. I can't say definitely because Thinkorswim has the capability of allowing you to upload custom indicators into the platform. You can upload custom scanners into Thinkorswim as well. I've got a scanner over here. It's a custom scanner that you need the code to give you the results you want. This is an Ichimoku Cloud. It's Ichimoku TK crossover scanner I use, so it helps me find TK crossovers on the stock market. So I just hit scan, put in my parameters, and then let it go.
okay, thanks.
So we're good? Anybody have any questions? So how many of you guys are familiar with how the MACD works? Essentially, the MACD indicator is a moving average convergence divergence indicator. The MACD is used to help you determine what the momentum of the stock is. It's also used to help you determine when a convergence or divergence is occurring. Now, a lot of people incorrectly use the moving average convergence divergence MACD indicator as a buy-sell indicator. It's not what it's designed to do. You shouldn't use it as a buy-sell indicator. It can work in some cases, but it also fails a lot as a straight buy-sell indicator. So like for example here, MACD. Let's go over the lines of the MACD indicator first. So the blue line over here is going to be your MACD line. It's going to be your MACD moving average line. And then the white line over here is going to be your signal line. So essentially, when the moving average line over here, this blue line, is above the signal line, above the white line, that means the bullish momentum is winning out. There's a lot more bullish momentum than bearish momentum for the stock at the moment. So back here, there was a lot more bullish momentum than bearish momentum. And when it crosses over below to the downside, when the line crosses below the signal line, moving average line crosses below the signal line, this shows that the momentum shifted to the downside. So there's more bears than bulls. So that's basically how these two lines interact with each other. So crossover, more bulls than bears, cross down below, more bears than bulls, and where these two lines are in relation to this purple line, which is going to be the zero line, determines what the overall momentum of the stock is on that given time frame you're looking at for the chart for the stock. So if these two lines are above the zero line, that means overall momentum for the stock is going to be bullish. If these two lines are below the zero line, purple line, then that means the overall momentum for the stock is bearish in that time frame you're looking at. Now, the green bars, light green bars, dark green bars, light red bars, dark red bars over here, this is the histogram. So essentially what it means when the green bars are light green, that means that the previous candle or the previous bar that came before, I'm sorry, that means the current bar has more bullish momentum than the previous bar that came before it. So as you can see, this green bar has more bullish momentum than the previous green bar. This next green bar also has more bullish momentum than the previous green bar. But after that, the next couple of green bars are dark green. So that shows that this green bar has less bullish momentum than the previous one. This one also has less than the previous, less than previous, less than previous. It peaked back up a little bit, more bullish momentum than the previous year, but it continued going down for the most part. That's the same with the red bars over here, the red histogram. If it's light red, that means that there's more seller momentum than the previous candle or the previous green, previous red bar. So you can see there was more, less, more. Now, the MACD is designed for the main purpose of showing you the momentum of the stock and when a convergence and divergence is happening on the stock. So a convergence is when the share price of the stock is moving down on the chart, but the MACD, these two lines, are moving up. So when a convergence comes to its close, when it comes to the very end of the convergence, typically what happens is that the share price will suddenly shoot up and have a pretty volatile move up. But it doesn't always happen. It's a percentage chance that it happens, as with anything that's technical stock trading. So convergence, share price comes down, MACD lines going up. At the end of a convergence, share price goes up. So divergence, share prices in a divergence, the share price is going up and the MACD is going down. At the end of a divergence, the share price is likely to drop off and tank. So that's typically what happens when a divergence happens. It's not guaranteed, like all technical indicators. It's a percentage chance that'll happen. So if we look at SPY, which is kind of a decent example of a divergence right now, if you look at this section over here of the MACD, you can see that the bar momentum is progressively going lower and lower and lower before it starts moving back up again. And you can see that the SPY is kind of progressively moving up higher towards the end, and then it finally starts to actually keeps on going higher, and then it drops off a little bit afterwards. So it kind of uses as an example right here, like right here to here, but it's not a perfect example. I've got a couple of better examples of a convergence divergence I can point out. So on Tesla, on this chart that was taken about 2 years ago, I believe, or 3 years ago, you can see that there is a divergence happening. Share price is moving up progressively, when the MACD is moving down progressively, and typically when this happens, the price snaps down, and you can see the price did snap down pretty sharply after the divergence came to a close. Got another example here. Okay, so for this one, it's another example of a divergence. So share price going up, the MACD going down. Typically towards the end of this move, the share price will shoot back down. So this is an example of a divergence. Let me see if I can get an example of a convergence. I know I have some. Let's see. So, don't know if I. Yeah, these two, same stock KO. It's an example of a convergence, but I mistakenly put MACD divergence on the chart. So ignore that. These two are examples of MACD convergences. So towards the end of a convergence, the share price should, in most cases, go back up. So it'll shoot back up.
So let me get this straight. With the MACD, you're seeing it trend down on that last KO picture that you posted up, and after it closes, it has a possibility to have a strong trend upward, right?
Yeah, after it closes. After the stock closes for the day, but sometimes it'll also happen at some point in its downtrend during the day. You'll see it snap back up. So stock doesn't necessarily have to close for it to start having that reaction.
Okay.
Does everybody understand how MACD works and how you shouldn't be using it as a direct buy-sell indicator?
Yes. Thank you, Fred.